If you're a high-earning Filipino professional who wants your idle cash and upcoming windfalls to actually move the needle this year, this episode is for you. In client work, I help professionals turn sitting cash and one-time inflows into clear, measurable progress, not just nicer balances or one-off upgrades. Here's the risk I see all the time. Cash piles up in low yield accounts and time deposits for safety, while bonuses, commissions, vested benefits, business distributions, even a property sale dissipate into low yield rollovers and lifestyle add ons. Like time deposits that auto renew, a gadget or appliance upgrade here, a quick trip there, extra subscriptions, plus tiny transfers scattered across multiple accounts. Then 5 years pass and everything felt fine, but major goals didn't accelerate. The fix isn't more motivation, it's pre-allocation architecture. And so we'll use a simple cash and windfall allocation framework, debt guardrails, safety tiers, a focused growth queue, plus autopilot rules to turn idle balances and new cash into durable gains. Spend 1 hour setting the rules now, and both your existing cash and each future windfall will take 5 minutes to deploy. And so you get earlier compounding, fewer regrets, and faster progress. Here's today's plan. First, we'll audit your idle cash baseline and your true after-tax windfalls. Second, we'll set guardrails for debt and right-size your buffers. Third, we'll build a 3-lane playbook with clear ranges and triggers you can copy in a notebook or spreadsheet. This is the same one-page worksheet I use with high earners, and it isn't about hoarding cash or chasing flashy bets. It's a repeatable system that raises net worth, lowers stress, and prevents felt okay at the time choices from robbing your next decade. Now, just a quick checkpoint. Before you allocate idle cash or a windfall, make sure your insurance premiums aren't quietly eating your budget. Grab my free Insider's Insurance Audit Playbook. It's a 60-minute checklist to find waste and keep your insurance coverage intact. Get the download in the show notes or in the description below. Now, here's how high earners typically handle lump sums. There's no judgment here, but these are the 3 patterns I see most often when serving my clients. Number 1, the parking lot. You know what it is. I'll park everything in savings or a time deposit while I think about it. Then life happens, the money gets mixed with everything else, and the decision never really happens. Number 2, the product path. Whoever you talk to around that time, a banker, an agent, a friend, frames the decision for you. So the money follows the product conversation, not your actual roadmap. Number 3, the reward spiral. It's the I've worked hard, so I deserve this mindset. Which is true, but when every windfall becomes a lifestyle upgrade, the big goals don't get the benefit. Now, none of these are irrational, okay? It's just what happens when there isn't a simple, pre-decided framework guiding big cash events. As we go, mentally label your default pattern. Are you the parking lot, the product path, or reward spiral, or some mix of the 3? That label is useful. It tells you what your system is missing. Now let's talk about the 3 jobs your extra cash can do. Any extra cash, whether it's sleeping money you already have or a lump sum that's on the way, can only really do 3 jobs. Number 1, it can reduce drag, like clean up expensive debt or heavy obligations. Number 2, it can be used to strengthen defense. It can be used to shore up buffers so shocks don't derail the plan. Check out the previous episode for a deeper dive on this. Or number 3, it can actually accelerate growth. You can use the money to fund long-term investing toward goals that actually matter to you. These are the opportunity funds I spoke about in the previous episode. Inside our coaching, we treat these as linked steps. First, check drag, then defense, then growth. That way, every big cash moment moves the whole system forward, not just one part. So right now, which job feels most urgent for your situation? Less drag? Stronger defense? Faster growth? Keep that answer in your head. It will guide the rest of this episode. Now, before we move on to step 1 of this process, let's talk about step 0, making sure the foundation isn't wobbly. Before we assign cash, we need to quickly check 3 foundations. First, check your direction. Do you have a short list of 3 to 5 goals with rough amounts and timelines? Check the video here for more details on how to do that. Number 2, protection. Is your insurance portfolio reasonably clean with premiums that make sense and big risks covered? Check out the video here for more details on that. And finally, number 3, buffers. Is your emergency fund right size for your context, not just a random big number, as I discussed in the episode here? If any of these are unclear, any allocation decision will still feel fuzzy because you're trying to deploy money without a clear map. Now, a quick rating exercise. On a scale of 1 to 10, how confident are you in your direction, protection, and buffers? Anything 7 or below is a flag. You don't have to fix it today, but be honest about the foundation you're making decisions from. And if you know one area is weak, use the Optimization Deep Dives playlist in the description or show notes to go back and build it in order. And while you're at it, grab my free Insider's Insurance Audit Playbook to release more cash by right-sizing your insurance coverage, dropping what you don't need, and rerouting the savings to your goals. Find the link in the show notes or in the description below. Now, step 1. Categorize the money, sleeping versus incoming. So we categorize because extra cash isn't one thing. Sleeping money is money that's already there, like idle cash or time deposits beyond your true emergency fund and operating needs, old investing money that never found a home, or oversized emergency funds that quietly stayed oversized. Incoming lump sums are opportunities likely to arrive in the next 12 to 24 months, like maybe coming bonuses, profit share, or commissions, stock options that are vesting soon, business distributions, proceeds from property sale. Now, sleeping money and incoming money are related but not identical. One is already sitting there, and the other is a future decision you can prepare for. Both deserve a deliberate plan. Next, estimate 2 numbers and write them down. First, how much sleeping money do you have above your true emergency fund? And second, over the next 12 to 24 months, what's a realistic ballpark for incoming lump sums? No need to be perfectly accurate, okay? You just want to feel the scale of the decisions. Step 2, decide your priority order. Here's the default hierarchy I recommend for most high earners. Drag, then defense, then growth. Number 1 is drag. Expensive debt and heavy obligations fall under this category. If you're carrying expensive consumer debt like credit cards, personal loans, short-term obligations, this is guaranteed negative compounding. Using extra cash here is often the highest confidence return you'll ever get. Then, number 2, your defense, your buffers and key risk gaps. If your buffers are below target, or there are obvious gaps that would force you to dismantle investments in a crisis, it usually makes sense to fix that before chasing higher returns. And finally, after addressing the first 2, growth. Long-term investing for named goals. Once drag is controlled and defense is solid, every extra peso should get a growth assignment. Which goal, what timeline, what investing approach. This isn't a rigid formula. It's a default order. You can still keep a small slice for lifestyle or generosity, but the bulk follows a clear hierarchy. Use this 3-question filter for every big cash event. Number 1, is there any expensive debt this should clear or reduce? Number 2, is my buffer at the level I've decided is enough? And number 3, which long-term goals do I most want to accelerate with this money? Your answers decide the priority. The rest of this episode helps you translate that into actual allocations. Now let's go to step 3. Sample allocation paths you can adapt. Let me make this concrete. Now, these are just starting points, not prescriptions. Scenario A. Let's say you still have some high interest debt. A reasonable default allocation might look like 80 to 90% to clearing or reducing that debt, and the remainder to topping up buffers if needed. No investing for now. Or take scenario B. You have no expensive debt, but your buffers are light. A reasonable default might look like 60 to 75% to reach your buffer target quickly, 20 to 30% to long-term investing, 5 to 10% for guilt-free enjoyment. Or take scenario C. Your defense is strong, and this is actually true growth capital. A reasonable default might look like 60 to 80% of the cash goes straight into long-term investing aligned with your goals and time horizon, and the rest toward near-term goals or lifestyle upgrades you're choosing intentionally. Now, the point is not the exact percentages. The point is you decide the story of the money before the emotions of the moment decide for you. Now, I recommend you write your baseline rule on one line. For example, by default, for any lump sum above X pesos, I will allocate A% to drag, B% to defense, C% to growth, and D% to lifestyle or generosity. And this statement will evolve over time. But having a default immediately makes your next cash event more intentional. Step number 4, match vehicles to time horizons without product noise. Once you know how much goes to growth, the next question is where to put it. The key variable is time horizon. For example, money you might need in the next 1 to 3 years generally stays in cash or near cash options. Money for 3 to 5 years can take some volatility but needs a measured approach. Money for anything above 5 years is where we normally design longer term portfolios. Inside our program, this is where we start connecting your allocations to a real engine: portfolio design, automation, and a review rhythm, so that every bonus and surplus knows exactly where it's going and why. So here's a simple exercise. For each big goal or planned use of your extra cash, write down the goal, the rough amount for that goal, and the target year you want to achieve it. Then do a sanity check. Is what you're planning to use consistent with that timeline, or are you taking too much risk or being overly conservative? Now, there are 3 traps I want to warn you about that usually derail good intentions for a lot of high earners. First, there's the wait for the perfect time trap. You get paralysis from trying to time markets or wait for that perfect rate so that cash just sits. Number 2, the every bonus is unique trap. You reinvent the decision on how to allocate every time you get the bonus, so nothing compounds into a system. Or number 3, the all or nothing trap. Swinging between extreme safety, all cash, and aggressive moves, one big investment, instead of a balanced, repeatable approach. There are 2 guardrails to prevent that. First, you must decide your default allocation rule before the money hits your account. And 2, commit that at least the first 70 to 80% of every major lump sum will follow the rule. The remaining 20 to 30% can stay flexible. That one choice alone stops you from wasting big money moments. If you're a high-earning Filipino professional sitting on sleeping money or expecting meaningful lump sums in the future, this is one of the highest leverage times to get help, because a good decision here affects years of outcomes. Inside the Beacon Financial Mastery Program, we look at both the money you already have and the money that's on the way. We design a path across drag, defense, and growth, so each cash event moves you closer to the version of freedom you actually care about. If you'd like a second pair of eyes on your plan, click the link in the description or show notes and message us BFM on Facebook Messenger. Or you can go straight to booking a free discovery call with us if you'd like someone to talk to and walk you through the decision to engage. We'll start there. Private, calm, no pressure, just clarity, so you can map your next cash decisions into a real system. Now, just to give a quick recap, here's a simple lump sum allocation rule you can use immediately. It's a 5-step worksheet you can fill in right away. Number 1, list your current sleeping money and estimate likely lump sums in the next 12 to 24 months. Number 2, confirm your target emergency fund and whether you're over, under, or on target. Number 3, note any expensive debt you'd be relieved to clear. Number 4, write your default allocation line. Remember that? For any lump sum over X pesos, my default is A% to debt, B% to buffers, C% to long-term investing, and D% to lifestyle or generosity. And finally, number 5, decide where the investing slice goes based on time horizon: short, medium, or long-term buckets. If you walk away with that one sentence written down and agreed on with your spouse or partner, you've already upgraded how your money behaves for the next few years. This whole optimization deep dive series is about getting your money system to operate at the same level as your career: calm, strategic, and repeatable. If this helped you see your finances more like a strategy problem and less like a pile of random decisions, consider subscribing on YouTube for more conversations like this. And remember, every episode in this series lives inside one place: the Optimization Deep Dives playlist. You'll find the playlist link in the description if you're on YouTube, or in the show notes if you're listening on the podcast. And just to recap the full arc of this series, episode 1 is where we built the foundation: your 3 to 5 goals shortlist and a goals-based cash flow system. Episode 2 is where we cleaned up protection, insurance that actually matches your plan and reduces premium drag. Episode 3 is where we right-sized and structured your cash buffers so you feel safe without over-parking cash. And finally, today, we have episode 4, where we set the decision logic for sleeping money and lump sums, so big cash moments move you meaningfully closer to freedom. If you want help tailoring this to your situation, you'll find the link in the description below or in the show notes. Message us BFM on Messenger, and we'll start there. No pressure, just clarity. That concludes the Optimization Deep Dive series. You've got the architecture, now go and run it. I'm Mon from Beacon Wealth Advisory. Thanks for listening.